buy and hold on Wall Street will crush your retirement plans. Come Q3 of 2021, my model says, based upon base effects, that you're going to have a huge surge into the gold market.
Please join us for our next live stream Sunday, January 24th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, January 24th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you are new to our channel or if you haven't already done so, please do subscribe, hit the bell to be notified on new updates, and give us a thumbs up if you like what we do. We truly do appreciate your support. A returning guest joins us today on SBTV, Michael Pento. Michael is the president and founder of Pento Portfolio Strategies, and he's a well-known money manager. Michael is also the author of the book titled The Coming Bond Market Collapse: How to Survive the Demise of the U.S. Debt Market. And we're delighted to have Michael back with us again as a return guest. It's time to saddle up and silver up for Michael Pento. Michael, welcome back to SBTV. How are you doing?
Always a pleasure to be with you, Patrick.
You know, Michael, looking back at 2020, it will definitely be remembered as the year a pandemic brought the world to its knees. Shutdowns of businesses as measures to contain the virus wreaked havoc on the economy, with many businesses going bankrupt. A lot of people lost their jobs. Why was it that we did not see a complete crash of the economy in 2020 despite a severe plunge in economic activity? Or did we have that collapse under cover of Fed intervention?
Well, the miracles of debt monetization. And we did have a plunge in 2020. Q2 GDP dropped at about 35% annualized rate. And then lo and behold, we ended up borrowing through the course of 2020, $4 trillion. And the Fed's balance sheet is now $7.35 trillion from where it was before this, which was under 4. So if you borrow a lot of money, if you borrow money and you do it from the private sector. So if I was a individual going to lend money to a corporation to generate capital goods, well, if that money was taken from that function and given to the government, that's a problem. But when the government comes in, borrows trillions upon trillions of dollars, and has it all monetized by the Fed, you're not taking away from that dynamic of me loaning to create capital goods to a corporation. You're not crowding out borrowing and savings from the private sector. You just monetizing debt, which will eventually cause broad inflation to occur. Right now, since 2008, all of the inflation, the vast majority of it, is all circulating around the canyons of Wall Street. Look at asset prices. Look at home prices. Look at bond prices. Look at stock prices. We're now at 190% of GDP, total market cap to the underlying economy, total market cap of equities to the underlying economy. That's never before even been dreamed of. Patrick, the normal ratio is like 0.6. We're now 1.9. So you're going to have the payback, which is inflation down the road.
Okay, so despite all this
broad inflation, not just on Wall Street.
Right. So, but Michael, despite all this money printing, stimulus, and all of these things coming up, why have we seen the yield, especially on the 10-year move?
Well, the 10-year note bottomed out at 0.5%. It used to be 1.3%. I think in the summer of 2016, it was 1.3%. And everybody said that you would never see rates that low again in the history of the human race. And then, lo and behold, just a few years later, there we are dropping down to 0.5%. That was last year. When you're that low, you're very, very vulnerable to a shock in bond yields. So bond yields have more than doubled on the 10-year benchmark note. And that's because of this zeitgeist that everything is returning to normal in 2021, this year. Everything will return to normal. And rates will just gradually, slowly, and innocuously rise to around 1.5% And that won't be enough, don't you know, to bother the stock market. And everything's going to be, rosy-dozy. I really highly doubt that's going to take place. So I believe that we have reached a influx of debt now to the point where we are going to have a complete bond market meltdown. All of the pieces are now set, and let me explain to it. So the deficit this year is already running at over 60% of last year, which was already a record year. So if you look at the first 3 months of fiscal 2021, so October, November, December, the deficit now is almost $600 billion. It's over 200 billion higher than it was in 2020. Now, so if you have annual deficits that are running at $4 trillion, that's 15 to 20% of GDP, Patrick. This is Banana Republic deficits. On top of 130% national debt to GDP ratio, we have $27 trillion, $28 trillion national debt. That's insolvency there, Patrick. You are now technically, in my opinion, and in not bankrupt, but you are an insolvent nation. And you then have Richard Clarida from the Fed, vice chair of the Fed, saying yesterday that we are going to not raise interest rates until the core rate of personal consumption expenditure price index, so core PCE, is 2% for a year. So you have an insolvent amount of debt now meets an inflation rate, the way the Fed measures it, at 2% on the core, which means the CPI is going to be 3%, at least on the headline, which means the real rate of inflation is going to be mid to high single digits at least. So when those two factors meet, you've got a very, very incendiary problem. But that's just 2/3 of the problem. The other third of the problem is you're going to have a Federal Reserve at that juncture, which is going to say, okay, we are now going to start to remove our bid because we have reached our goal of 2% inflation. So let's just put that whole pie together. An insolvent nation's debt with onerous overhang of debt, with Banana Republic-like deficits, meets inflation beginning to run intractable, meets a Fed that is removing its indiscriminate $120 billion a month bid for treasury bonds and mortgage-backed securities. I don't think that is going to lead to a very innocuous, very gradual, very peaceful rise in interest rates. What you're going to have is panic in the bond market as everybody tries to front run the Fed from getting out of their bond buying business. Okay? So if you have, let's just say, if you have nominal GDP running at around 5%, so say 2.5 inflation, 2.5 growth, the 10-year note should be about 5.5%, historically speaking. It should be slightly above nominal GDP. Well, it's not there. It's 1%, Patrick. Just around 1%. So you could have a shock in the bond market, prices plunge, yields soar, and what do you think that's going to do to a stock market that's trading at 190% of GDP? So we at Pento Portfolio Strategies, we monitor these dynamics and we play these cycles of inflation, deflation, growth, and recession. That is the smartest thing you can do. The buy and hold mantra. Let's just say you're a buy and hold investor and you've been told by Morgan Stanley or whoever. I'm not saying that they say this, but I call it the deep state of Wall Street. Well, just buy a 60-40 portfolio, 60% stocks, 40% bonds, depending on your age, and you'll be fine. Just hold for the long run. But I just went through the scenario, and I think pretty cogently. I'm not trying to be, I'm not bragging. I'm just saying, just lay down a bunch of facts that are very verifiable, you or your audience. So it's all facts. This is what the Fed said. This is where the debt is, and this is what's going to happen. They're eventually going to pull their bid from the bond market. Well, if you own a 60-40 portfolio, by definition, of course, you're going to get crushed on your bond portfolio, which is supposed to be the ballast in the portfolio. It's supposed to offset what's happening to stocks, and stocks are going to crater because the valuation has to come down, because the 10-year note valuation at 1% is a lot different than a 10-year note at 3% or 4% or even much higher. You're going to lose money on both portions of your portfolio, your fixed income and your equity.
Michael, you wrote in a recent article that the Fed is buying new types of debt, including municipal and corporate bonds, even junk rated for the first time ever. More specifically, in your article, you said, at the end of this crisis, we will have an even bigger mountain of debt, interest rates that are even further into the twilight zone, and the seeds of a runaway inflation that have been fertilized with a gigantic pile of poop from a massive herd of government-fattened brontosauruses. What are the implications and consequences from the Fed buying these new types of debt? How much more problematic has this added in to the equation?
Well, we've gone from a central bank in 1913. The Fed wasn't buying really much of any debt at all. They were just an emergency lender at the discount window. But we went from monetizing a slight amount of treasuries to now monetizing junk bonds, to making loans in the primary market to corporations. We monetize mortgage-backed securities. We probably on the next downturn will start monetizing stocks, just like the Bank of Japan does. So we have a central bank that's become, they have supplanted the market completely. They own the real estate market now. They own the stock market now. That's never been the case ever before. So we have a central bank now that is in the business of curing pandemics. We always talked about treasuries, mortgage-backed securities, and junk bonds, soon to be stocks, but now they're curing pandemics. They also are now in the business of, very soon, to making sure they vanquish any kind of racial inequalities. They're on record saying this, Patrick. This is what they want to do. They want to print money. They said the almighty printing press can fix everything. It can fix any kind of recession. It could ameliorate any kind of downtick in the stock market. It could make the economy healthy from a pandemic, and it could end any racial inequalities. This is what they say. I'm not espousing that we should have racial inequality. I'm just saying the fix. In fact, I'm very much against that. I want to make that very clear. So I'm not prejudiced at all. But the tool, the mechanism to fix that isn't the Federal Reserve. It's having religion, having two-parent families, believing in Christ. That's how you fix racial inequalities. Let's be real and honest here. That's what you're going to get from me. The answer is having a two-parent family to raise the children in a God-fearing home. That would be a nice way to attack racial imbalances and inequalities. The answer isn't to monetize all your problems away, because what you do, here's a great example. We have had since the pandemic. This is not new, but since the pandemic, the gap between the very rich and the poor is yawning now. It's getting larger and larger. Well, who's more prone to be in the lower classes is, it's a fact. Lots of white people are in there too, but there's a lot of minorities in there too. Well, these people have, they're blue collar workers. Maybe if you're working at a restaurant, bar, or leisure hospitality, you lost your job due to lockdowns. You don't have the massive portfolio of stocks and bonds and real estate that's the primary beneficiary from the Fed's printing. So you're going further and further behind, where people who are white collar workers, they can work from home, they can do Zoom calls, they have real estate, they own their houses, they own maybe multiple homes, they own a lot of stocks, they own a lot of bonds, and they're doing fantastic. It's been the best year for them. So how does, what I just said was all true, how does then the Fed, by monetizing even more debt, end racial inequality? Explain that to me. It doesn't. It exacerbates the condition.
Yeah, they've moved quite a bit away from their mandate of maximum employment and price stability there by doing these things. Uh, but do you think the Fed now they are absolutely trapped with zero interest rates?
Well, they said that they're not even thinking about thinking, and maybe they'll add, thinking, squared, or maybe to the 10th power. I don't know how many thinking they're going to be thinking about before they raise off the zero bound. It's going to be years and years. So what happens when what is the function when you have zero interest rates forever? You buy a lot more asset prices go through the room. You buy a lot more stocks, you buy a lot more bonds, you buy a lot more houses, right? That's what happens. So these bubbles will get much bigger than they are now. And eventually, when the Fed removes that bit, eventually we'll have to all understand that eventually, especially now when you have a Democratic sweep of the White House, of the Senate and Congress, you're going to get a lot more spending. Not to say that the Republicans are fiscal conservatives, because when they get in, they spend like Democrats. But now the Democrats are in, they'll spend like Democrats. So you're going to have a lot more debt and deficits added to the pile, which will be monetized by Janet Yellen in cooperation, who's the Treasury Secretary now. Supposed to be like a wall between these, the Treasury and the Fed. That's gone. So you have the Treasury in Kumbaya, singing Kumbaya with Mr. Powell at the Fed. It'll all be monetized, so inflation's going to run hot, and sooner or later, the Fed's going to have to agree to pull back on their stimulus, and that means all of these asset prices are going to crash. So what else happens when you have asset bubbles, when you have 0% interest rates? What occurs is you are compelled, you being the private sector, to take on a lot more debt. The public and private sector are compelled to say, hey, look how quiescent interest rates are. Why don't I take out another loan and buy that second home? Why don't I go and float some more bonds to the corporate debt market and keep the zombie companies alive? Why don't I take more margin debt risk, buy stocks? If I'm the federal government, we have an opportunity here. Interest rates are at an all-time record low. So debt service payments are low, even though the amount of debt is higher. So we have to, this is an opportunity to rebuild every bridge in the nation and repave every road in the nation, build some highways too, maybe some airports to nowhere. So that's where we're headed. That's what happens with 0% interest rates. That is the history of them. They create more imbalances and making the economy much more unstable.
Yeah, that's what I was going to ask. Where what is it going to take to transfer that inflation over from Wall Street to Main Street? Is it and give people the confidence to spend? Is it going to be more stimulus? Is it going to be perhaps long-term infrastructure type jobs where guys feel secure with their paychecks and they'll go ahead and spend? How do you think it's going to transfer over from Wall Street to Main Street?
You know what I find amazing is, Patrick, is that all of the PhDs that sit at the Eccles building in DC, I don't understand how they don't get what inflation is. They have all these papers out there. They've studied it for decades. So they're either lying about inflation, or they're being, they're nefarious about their understanding of inflation, or they're just feckless. I don't know what it is, but listen. The classic definition of inflation is an increase in the money supply. We all know that. But what causes broad-based money supply to increase? Not just the base money supply. That's what the Fed controls, base money supply. Okay, so that's physical currency and Fed credit. But what do we get? What do we need to get inflation really going? Is we need the broader aggregates to explode. That comes from lending from banks. The other way to do that. And it's hard to get banks to lend to the private sector because we have so much debt outstanding. Even household debt is very high, although it's come down some from 2008. But the corporate sector, they're saturated in debt. So the other way you can get the money supply growing on the broader aggregates, M2 and M3, is what you need to do is to have the Fed directly monetize debt from the Treasury. So Treasury comes out and says, I'm going to give everybody checks in the mail. Think about universal basic income, because that's, I think, where we're headed. So everybody knows now that a family of four who makes less than $100,000 a year will now make $100,000 a year. We're going to get checks in the mail every week or every month. I don't know how they do it. And all of that's going to be monetized by the Fed. Well, that's a direct increase in the broader monetary aggregates. You don't need banks to lend money. The government is sending you a check. Gets monetized by the Fed. Broader monetary aggregates explode. This debt that we've incurred and the money that's been supplied, that's been increased, isn't going to any kind of increase in productivity. There's no increase in the amount of goods and services available to purchase. It's just money being doled out through universal basic income. So yes, then you'll get a booming money supply across the board, not just on Wall Street. And since you haven't had the money being loaned out or sent out to increase productivity, you will get massive inflation.
Yeah.
And that will eventually cause the Fed to react. And you don't want to be anywhere near the stock market when that happens. Nowhere near it. In fact, you want to be short the stock market. That's what we do here. We actually, we can be 100% cash. We can be 100% gold. We can be 100% bonds. We can be short the market. So you have to have the flexibility, because believe me, and I mentioned this before, I'll say it again, underscore it. Buy and hold on Wall Street will crush your retirement plans. No longer works.
Getting back to the bond market, the bubble you have warned for years has to do with the bond market bubble. How much worse has that bond market bubble become as a result of 2020 compared back in 2008?
Well, the bubble's been building. I wrote a book in 2013 about the coming bond market crash. At that point, it was completely anathema to me that we would have $20 trillion worth of sovereign debt around the world with a minus sign in front of it. So I never even imagined it. But the bond bubble is building. It's not that the bubble doesn't exist. The bubble is getting bigger and bigger. We just saw it. 100% increase in treasury yields year over year. But that's nothing. From 50 basis points to 100 basis points is nothing. What we have now is just, as I went and explained very succinctly in the start of this interview, we have just exacerbated every function of the coming inflationary and insolvency implosion of the bond market. We've massively increased the amount of debt. We've warped and distorted interest rates to the basement of history. And they can't get much lower than they are now. I mean, you're at zero on the Fed funds rate. And even a 1% benchmark treasury is still, the average yield on the treasury, if you go from 1960 to 2000, was 7%, according to Bloomberg's data. So we're nowhere near average. And of course, the missing piece now is inflation, which is, according to the Fed, they're not going to stop printing money until they get 2% the way they measure it. So you think about mid to high single digits. So all the functions of a bond bubble implosion are there and have gotten much worse since started in 2000, 2008, and then 2020, which with each new, if you notice, with each new recession caused by these bubbles, the Fed is forced to get lower and lower and lower on their interest rate. Look what's going on in Japan and Europe. They're already at zero, actually negative deposit rates. So that's probably where we're headed down the road.
Okay, so what happens with pension funds? Are they going to be wiped out as well?
Well, I mean, pension funds will first be, made whole by all the inflation. I mean, you have Mitch McConnell in the Senate, who was holding back on Pelosi's CARES Act, HEROES Act, which was $3 trillion of additional stimulus, because he didn't want to send aid to the states. Well, now you're not going to have Mitch McConnell. You have Chuck Schumer with the gavel in the Senate. So I could imagine trillions being poured out to the states to make their pension obligations whole. So if that's the case, you think logically down the road, if that's just one iteration of these, cycles of bailouts, until we get to intractable inflation. I imagine that there'll be many trillion-dollar rescue packages. You'll get paid in nominal terms. It won't buy you what you think you're, just because you're made whole in the nominal amount of money owed to you doesn't mean your purchasing power doesn't go down, because it will. And that will stay the course until we have intractable inflation, when the Fed finally gives up and says, throws their hands up and say, listen, inflation is destroying the economy. I have to pull back. And that's eventually what's going to happen. Then you have this big reset where the currency resets, the debt resets, very deflationary, depressionary. But that's only after the Fed gives up. I mean, we're so far away from that. We're years and years away from that. So we're going to have many cycles, many iterations of these boom busts where the bubbles get bigger, the crashes get more severe, and lather, rinse, repeat until you have this ultimate crash where the Fed says, we can't do this any longer. But they're far away from that.
With all of these things that you're saying and the dangers in the financial markets, would you advocate holding US dollars at this point? I mean, we hear a lot of people say cash is trash, or there's an expiration date on cash. What do we do with the US dollar?
Well, if you look at Russia recently, Russia has more gold in their reserves than US dollars, simply because they want to get away from dollar hegemony. So the dollar is losing its status as the world's reserve currency. It's inevitable. The question is, well, if you don't own dollars, what do you own? Do you fly into euros, or do you go into yen or renminbi? No, you don't. So I think that, and long term, gold is where you have to go. But again, since we're active managers here, there are times when you overweight gold. We were 25% gold not too long ago. We went down to 5% because what does gold not like more than anything is rising real interest rates. This is exactly what you have now. But come Q3 of 2021, we believe, that's what my model says. I have an inflation, deflation, and economic cycle model. My model says, based upon base effects, that you're going to have a huge surge into the gold market, because the rate of change of growth and inflation is going to reverse from being something phenomenal in the second quarter to something very, very lackluster in the second half of 2021. So that's when you probably want to buy gold, because nominal rates will be falling. At the same time, real rates are falling very, very quickly.
How about Bitcoin? What's your view on Bitcoin and the excitement that we're seeing over its rise currently?
Okay, so I have been wrong with Bitcoin. I'll do a mea culpa on Bitcoin. I was wrong about Bitcoin, about its direction, about its price. What I am not wrong about, which I feel very strongly, is that I do not think Bitcoin is better than gold. It's not gold 2.0. It's not 10x better than gold, because Bitcoin, although Bitcoins are rare, they say it's more rare than gold. Although I noticed that Bitcoin can fork and split, so I don't really quite understand what that's all about. But let's just assume that the number of Bitcoins are limited. Well, in that case, you say, well, what's the use of having 34 in your private key? You have 34 numbers and letters sitting on your hard drive. Well, why would 34 numbers and electronic numbers and letters ever be worth $40,000? 34 numbers and letters. They're not rare. They're not uncommon. They're only of use on this blockchain. Well, what's their use, you say? Well, you can move a coin along the Bitcoin blockchain, and it's immutable, it's decentralized, and it's anonymous. Oh, well, that gives these 34 numbers a lot of value, you say. Okay. But then there's unlimited number of cryptocurrencies out there that are already out there. There's thousands of them. And there's unlimited supply of blockchain cryptocurrencies that can perform the same basic function of moving a coin along a blockchain that's anonymous, decentralized, and immutable. The transaction is immutable. So if it's an unlimited number of these cryptocurrencies that can be created, then what makes Bitcoin so much more valuable than the rest of them? Some people say it is. Some people say it's the only coin that makes any sense. Well, if that's the case, then why is all the other coins going up? They should all be zero. And then of course, and I don't want to be a long diatribe on Bitcoin or cryptocurrencies, but here's another thing. They love the cryptocurrency. The followers of cryptocurrency always espouse this, that it's something that's can't be shut down. Government, it's outside the reach of governments. They can't shut it down. This decentralized aspect of it. But then they want to be, listed on exchange. They want it to be custodied by Wall Street. They want to have exchanges on the internet. So here's what could happen. Here's my fear. One day, the governments around the world are going to say, and they'll say this because they don't really like to lose control over their own currencies. This is why they're highly motivated to say, you know what, because of AML laws and know your customer, anti-money laundering and know your customer laws, cryptocurrencies are now illegal. Like, anybody caught transacting in the cryptocurrency is subject to fines and or imprisonment. And all of the exchanges are now outlawed. An exchange, if you go to Coinbase, the biggest exchange, one of the biggest exchanges out there, it's a website. The government can see that. So if Coinbase is outlawed, it's gone. It's gone. Maybe there's something on the dark web you can go to buy your Bitcoins, but all of the transparency, all the liquidity goes out of cryptocurrencies. It vanishes overnight if Coinbase is illegal and all the other exchanges are illegal. So then how does one get a Bitcoin? You have to download a wallet, right? You have to download a wallet. Where do you go to download a wallet? Where do you trust the transaction of buying a Bitcoin or transacting a Bitcoin if you're doing it on the dark web? So government may not be able to, and I agree with this. The cryptocurrency folks will agree with, we're simpatico on this. Government cannot vanquish totally Bitcoin, but they can make its price a whole heck of a lot lower than $40,000 a year. That's for sure. And that's probably coming. And I don't want to be on the other side. I had somebody, just to wrap this up, I had somebody tell me that if, Bitcoin was going to be the same market cap as gold, it would be, and I forgot the number now, it was, hundreds of thousands of dollars, or if not $1 million a unit for 34 letters and numbers that sit on your hard drive. You don't want to be on the other end of that when the government says, okay, this has gone too far. It's a bubble. It's interfering with the dollar. We're shutting down Coinbase. Don't be on the other side of that.
Okay, last couple of questions here. Do you think 2021 is going to be a better year compared to 2020 economically? And do you think 2021 will be the year that we start to see central bank digital currencies rolled out?
Okay, so it's an artificial construct, 2021. Well, it starts in January, ends in December. So it's an artificial construct. Let's look at what's going to happen this year. The first part of this year, you're going to have accelerating growth and accelerating inflation with a very, very friendly Fed. Free money and $120 billion a month in QE. Could be a very good first half of the year. It's the second half of the year that I'm very worried about. I'm very worried about the Fed breaching its target on inflation. I'm very worried about the Fed beginning to announce that they're going to attenuate the purchases of mortgage-backed securities and treasuries. And I'm very worried about the $5 trillion. We're going to have, so we had $4 trillion in 2020 in fiscal stimulus. We could have, from what I hear now, Mr. Biden wants to put between $1 to $2 trillion. And I heard 2 trillion, the latest number. So you could have $6 trillion of fiscal stimulus, all of it monetized by the Fed, between March of 2020 and March of 2021. That's the year I'll look at. So you think about a few months after all of this, infrastructure gets passed and the fiscal cliff comes from in the second half of 2021, from the roll-off of $6 trillion in fiscal stimulus. At the same time, we have inflation running wild. At the same time, we have asset bubbles through the roof. At the same time, the Fed pulls the plug on the whole darn thing. That's what I'm concerned about. So it's not what the year is going to be, the whole year. It's what are you doing during the year? Are you riding this bubble higher earlier in the year like we are and have been? Are you then out and protected and short the market when LIBOR OIS spreads break down, when break higher, when high yield spreads break out, when break even spreads collapse? I mean, I have a 20-point model that I monitor every day. So let me know when it's time to get out of harm's way. There could be a time later this year when rising yields pop this whole bubble. At the same time, the Fed pulls the plug on the whole thing. So that's what you have to worry about.
Okay.
But you don't have to worry about it you have to worry about it if you're not with an active manager. If you are with an active manager, maybe you don't.
Michael Pento, before we wrap up, can you let our listeners know more about what you do and how they can find your work and go to you to be that active manager?
Okay. Well, I have a website, pentoport.com. My email address is mpento@pentoport.com. The office number here is 732-772-9500. You can go to my website and get a free trial. It's 5-week free trial of the midweek reality check. I think it's 5 weeks free trial. It's only less than $50 a year if you want to become a subscriber, just to let you know what I'm thinking at a high level. If you want to become a client, if you have around $100,000 to invest, that's our minimum. We'll take good care of you here, and that's what you have to do. It's a lazy way to invest to say, someday something's going to happen, or don't worry about what's going to happen, and don't worry about crashes, don't worry about recessions, don't worry about the Fed, because long term it's time in the market, not timing the market. Well, that's for people who don't understand economics and markets. If you understand them well enough, you can do a better job of protecting your clients' assets. Because how many times, if you're approaching retirement, how many times can you suffer a 30, 50 to 80% drawdown in your assets? It happened in 2000, happened in 2008, happened in 2018 when the Russell lost 30% in a matter of a few weeks. It happened in 2020 because of the Wuhan virus breakout. And it's going to happen again when the Fed pulls the plug on their manipulation of asset prices and interest rates and money supply. So instead of worrying about that, get ahead of it. Understand it, get ahead of it, know what factors and style factors and sectors to own in the various iterations between inflation, deflation, growth, and recession. And you'll be able to, in that way, hopefully ride these bubbles higher when they're growing, but protect and profit when they crash.
Great words of advice. We appreciate that, Michael. Again, we do wish you all the best, and we thank you for spending some time with us, and I hope we can do it again soon. All the best in 2021.
Blessings to you too, Patrick. Take care.
That was Michael Pento, president and founder of Pento Portfolio Strategies. For more info on his work and his views on the economy, please visit his website, pentoport.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. Do also check out the SBTV podcast on iTunes and Spotify.